Good afternoon, good morning, good evening, wherever you are in the world. My name is Navin Raunier. We are going to talk around the challenges of the Libor transition. I am a partner running the Libor transition globally at TCS. I have over 50 different clients. We're globally present and working on the Libor transition in likes of South Africa, Australia, Middle East, Asia, Europe, UK, and obviously America, where there's a lot of drama going on around the Libor transition, as we all know. And one person who certainly knows about this drama is Tom Wipf. Very pleased and humbly welcome Tom Wipf to our podcast today. So Tom is the chair of the ARC, as known as the Federal Reserve Board's Alternative Reference Rates Committee. He is also the vice chair of the ISU, Institutional Securities business at Morgan Stanley as well. So I'd like to just spend a little bit of time talking to Tom today and understanding where we are with the Libor transition. So just a quick word from Tom. How are you today, and Happy New Year as well?
Thank you. Happy New Year to you too. We've had with so much news that we got towards the end of last year, I think it's a really good time for this podcast as we can all begin to process all the information that we received late in 2020 and how we're going to take all that forward into here in 2021.
Thank you so much, Tom. So let's get stuck into it. Now, we came to close as of 2020, and US dollar Libor, as you know, the consultation through ICE, and we are looking, and the industry has interpreted this as a delay for certain tenors to 2023. Now, it'd be interesting to get your point of view here, Tom. From an ARC perspective, what is your view around this delay that is going to crystallize into a delay after the ICE consultation end of January? And is there going to be does this give firms reprieve on their implementation, especially with the ongoing pandemic? Your thoughts, Tom?
Yeah, thanks. What we've tried to do at the ARC is really take all of these announcements together almost as a package and really view all the things that we heard from IBA, from the FCA, from the U.S. regulators, and really boil that down to what is the goal of all of these things combined. And I think, we wouldn't want to misconstrue what we're seeing as a reprieve. I think rather it sends a really clear path on the transition. So with all the progress that's been made and the end of new Libor production approaching, I think we think about this in a couple of categories. The first is basically what's being created is a roll down corridor between end of 2021 and June of 2023, because the goal of that was really to allow many legacy contracts, more than half, to roll down during that window. And the way that would be accomplished is the second piece, and I think a really important piece of this is the guidance, the supervisory guidance we got around no new Libor, either as soon as practicable or no later than the end of 2021. And I think the guidance from regulators around the world, but in the U.S. in particular on dollar Libor, was really specific, talking about consumer protection, litigation, and reputational risks that the Fed, the OCC, and the FDIC believe that entering into new contracts that use Libor as a reference rate after the end of this year would create safety and soundness risks. And we assume that bank practices will be examined under that spotlight. So the idea of saying no new Libor after the end of this year or as soon as practicable, having this roll down corridor which will reduce that legacy book dramatically, and that third leg is really giving us time to work through several of the legislative issues around dollar Libor, both in New York State and federal legislation, that potentially could address the challenges that we see in tough legacy products like securitizations and floating rate notes and trust prefers and other things that have floating features that exist long after Libor is gone. So we put the consultations together, when we put the supervisory guidance together, and we combine everything. We've got a package is a defined roll down period that will extend for 18 months beyond the original deadline. We'll see a complete reduction in production of new LIBOR or new LIBOR contracts happening sort of in the second half of this year towards the end of 2021. And then an ability to really focus on the biggest challenges we see for market participants, investors, and others around the toughest of legacy to make sure that we can get a sound legislative solution to that. So when we put it all together, we think this is a real package that provides a clear path for transition, presents certainty, and when you overlay that with the consultations that IBA is doing, at some point, we've removed the concept of sort of a zombie LIBOR. It seems that certainly in reading through this, it would seem that cessation is a much greater likelihood than pre-cessation, which was something that we were really focused on last year. So it does provide a lot of clarity going forward. We wouldn't want people in the market to misconstrue this as a reprieve, but really just a clarity of path forward.
So talking about the word reprieve, what we're observing in the industry as well, especially in the Americas, is a number of institutions who are seeing this as a way to delay their transition, because they are obviously quite focused on the ongoing pandemic, lending to the real economy. Mm-hmm. Those issues, right, and the geopolitical issues, and obviously we just had Brexit as well. Don't you think that fundamentally that institutions are naturally going to pivot towards the more important issues, such as the virus, over LIBOR transition, and that's the reason for the delay, or for them to delay their transition planning?
It's interesting when you go back to sort of March and April. I think it was made pretty clear by the regulators, particularly the FCA and the FSB, that LIBOR transition remains a top priority. And as much as we've been able to accomplish so much from this work from home environment, even from an ARC perspective, we met twice as many times in 2020 as we had in 2019, because we really had access to our membership in a very different way. So the work really continued. Yeah, it's always a risk of deprioritization. I'm sure from where you sit in your organization, you have across the you have a horizontal perspective on that. And I think what we've seen is there's two pieces of the puzzle. And parts of the organization that are running the transition from an infrastructure, operations, technology, build out, repapering, this will be viewed as time well spent to make sure that all those things happen in time for the end of LIBOR. But if you think about from a front office perspective, from a new product perspective, from a trading perspective, from a risk management perspective, the notion of no new LIBOR could actually present more interesting challenges than actually no LIBOR at all. And so when you think about risk management systems, modeling, all the things that have to happen to live in a world where LIBOR will exist in a representative form, but you won't be able to trade it, is something I think that's going to that will accelerate that work. And actually the time allotted, this additional 18 months, will actually be pointed towards, I think, the groups that probably could use more time: technology, operations, repapering, legal, compliance, and all the things that have to happen. But meanwhile, from a risk management perspective, if anything, I think we may have accelerated the process, and the challenge itself becomes just slightly more complex in dealing with no new LIBOR as opposed to no LIBOR at all.
So on that, on that point, the ARC have got some excellent material on the website on those downstream impacts, as we call them in the industry, from an accounting, finance, tax, risk, legal, etc. perspective. What other efforts are the ARC making to strengthen those downstream impacts and really understand the crux of implementing LIBOR transition? Because remember, it's only a certain portion of LIBOR tenors, especially the US dollar 3-month point, that is obviously going to 2023, but the other ones are still going to be retired as well.
Yeah, I think those working groups, I think, are the groups that probably will be the beneficiaries of a bit more time. And I think that getting whether it be vendors, whether third party vendors, whether it be the work that has to happen across organizations from a operation technology perspective. I think all of our working groups, when we think about it, all have sort of different different paths. But the operations and infrastructure working group has worked diligently to pull together subject matter expertise, and across our the more than 1,000 individuals who are around the ARC's work. That group in particular, I think will take this time wisely, and will begin to make recommendations up to the ARC in terms of how to make perhaps more best practices or things that people can do around that work, because that really is always, and we've known that from the beginning, one of the more challenging pieces of work, and one of the more I'd say extremely active and working groups that we have.
Perfect. So talking about one of those downstream impacts is on the legal side, and looking at fallback protocol, especially the famous one that's being published by ISDA, right? So we know there's about 400 firms that have signed up so far to the protocol, but there's still some big names in the industry who are yet to do so as well. I mean, from your interactions as being a leader of the ARC, and obviously being a senior leader at Morgan Stanley as well, how are you looking to overcome those issues? And are you taking the feedback from number of concerns that are being, let me politely say, vented to regulatory bodies?
Well, if I think about the ISDA protocol rollout, certainly I think it was a very smart approach, taking this escrow period where most of the big banks and derivatives dealers were engaged in the protocol and had signed up to the protocol prior to the release, which gave clients, I think, a lot of comfort that if they look across their counterparties, I think in most cases they can see that all of their major counterparties have already adhered, and then that allows them to do their work to get their own legal view of the protocol and go down that path without the concern that perhaps one or two of their counterparties hadn't signed. So I think from clients looking at their bank and dealer counterparties, I think that was a great approach. I think we look at this at an entity basis. There's over 5,600 entities have signed up over the period, but you're right to say that many people have multiple entities. So looking at that, and there are some notable absences in terms of market participants, but we're also approaching the implementation date on January 25th of the Big Bang,
yep,
which would mean that participants who haven't signed, their new activity will in fact be governed under the same terms as the protocol applies to in legacy. So we expect that there'll be, I would expect there'll be more take up in advance of that Big Bang. So between now and the 25th, I would watch this. I mean, every day, they ring up a couple of hundred new entities. And so I'd say progress is okay. If we pass the January 25th date and there are, meaningful market participants that haven't signed up yet, I think firms, each individual firm who engages with those counterparties and clients will begin to probably have more different discussions. And don't forget that it seems like a small number, but $500, it's a $500 charge has been waived up until the 25th, at which point it costs you money. So if you have a few entities, but you think about we expect to see, I would expect to see a big take up in advance of the 25th, because at that point, if you've got cleared and bilateral activity, right, your cleared activity is already going to be under the terms of the protocol. Your new activity will be under the terms of the protocol on a cleared or bilateral basis, and you're just going to be left with this stub of bilateral activity that's going to be under different terms and fallback. So I suspect that things will reconcile as we approach and pass January 25th.
But what about the concerns around NonLinear products as well that that ISDA don't cover? And say, let's take a very complex structured product, for example. What are the sort of efforts that are coming through from the ARC to address those concerns?
I think we've gotten, we at the ARC have always focused on those things with I think probably top subject matter experts to put together thoughts on how to take these things forward. But again, we're talking about, probably the most complex products that we're addressing here. And I think over time, we're going to be looking for market participants, ISDA, the ARC, to just really provide, collective solutions to these things as we go forward. But, the work is happening, and I think fortunately for the for the market participants and engage in that, there's a lot of intellectual content available to us to get that work done. But yeah, it is something that's on the agenda, and it's going to take a lot of work to get us through that last piece.
So I think the messaging there is stay tuned to those working groups that the ARC have convened. And
a lot of focus, yes, sir.
Perfect. So, moving on, for our clients, LIBOR transition, data. And we now have the concept of a CDO, and that's quite a challenging job, looking at data and where data's floating around, given, number of banks have taken over other banks and other companies, mergers and acquisitions, etc., right? We know data is a challenge, right? We know there are other regulations such as BCPS 239, FRTB under the Basel regs that govern how you look at data, especially market data as well. What are the efforts of the ARC to educate the community around getting your data in order, i.e. your inventory or your SOFR historical time series, getting those legacy exposures monitored, board reporting, etc., and obviously pushing that onto the CDO as well. The interactions there, Tom. Before I go into market data.
Sure. Look, I think every firm is trying to look at the key data points they need to manage this transition, whether that be notionals, whether it be DV01, whatever their factor is, how many contracts they have to change. Each one of these categories across anyone's transition plan will have a source of common data to their organization. That may be distinct somewhat by organization, but clearly notionals, DV01, number of contracts will be shared across probably most organizations, if not all organizations. I suspect that one of the key drivers to this will be how supervisors approach this, how the official sector regulators and supervisors look for the data that they're looking to seek and serve to rationalize that data across all the horizontals that they regulate. So I suspect that everyone has kind of the key points that they're focused on for their firm, and everyone's, to the extent that people's business models are different. One organization may have a lot more focus on their mortgage activity, and one may have a lot more focus on their derivatives activity. So I think every organization should have their own set of data, but ultimately I suspect that as regulators begin to supervise more closely as we approach the deadline, that will probably be the final piece of the puzzle that will give us, I think, some good common data sources across the industry.
Thanks for that, Tom. So we know there's data to identify. Now there's more market data coming along. So Term SONIA has gone live this week from Refinitiv and ICE, from a number of different, using a different number of data sources as well, broker-dealer, etc. ARC has obviously floated an RFP for Term SOFR. Given the UK is pushing the Term RFR agenda, maybe because Brexit has been done now, and maybe as Brits we're not going to follow rules in the EU. We don't know that yet. Yeah, that's still outstanding position. What about Term SOFR? Given that the Brits are now actively encouraging Term SONIA, your thoughts there?
Yeah, our thoughts around this have, and we've been, I think, for the last year or so, we've been trying to be very clear that Term SOFR is a market dependent, is really dependent on the market, and making sure that more and more market participants begin to utilize SOFR as a first choice over LIBOR. And we've expected that when the protocol becomes active, when we get past the big bang, we've had the CCP conversion, that eventually so many things are in place that we'll begin to see enough activity in the market. As you noted, the ARC has an RFP out for an administrator. Obviously, creating the methodology will be obviously something that will be certainly hopefully easily achievable. Selecting the administrator, that will happen through a very formalized process at the ARC. But endorsing a rate will really involve two things. First is that there's enough activity to support whatever contracts are going to rely on that rate. And then I think, as importantly, really thinking about use case. And use case, I think, is the piece where, we have to be really specific, because we want to go back to first principles. We got here because we had 400 trillion in contracts resting on less than $1 billion in live transactions. What we don't want to do is create something where the appeal of term SOFR is so great that we end up putting more contracts on top of it than it can really support, right? Because uses of SOFR on an overnight averaging basis, compounded in advance, compounded in arrears, should support a vast majority, 80–90% of the market. So when we think we think that the use case for term SOFR will be as critical as the development, as the methodology, as the administrator, and the ability to the ARC to endorse that will have to be informed by what we think use cases are. And we ask the question, not necessarily what uses do we have for term SOFR, but why can't particular activities just use SOFR in advance, in arrears, or overnight? What is the need for it, as opposed to what can't you cover with the existing tools available with SOFR?
So, Tom, do you feel that you will be following in the footsteps of the Bank of England and RFR working group committee there, who have basically suggested term rates for the trade financing, leasing financing industries, Islamic financing as well, which is a growing industry as well? Do you see a similar path there, and any timelines that you can that you can provide clarification on to help our clients?
I certainly think that from the work of the UK RFR and the FCA and the Bank of England, we've seen some great best practices that we've brought on board on the ARC. We've sent there's been a lot of leadership from that group in sort of setting a path. I don't know where we'll land in terms of how prescriptive we actually can be in terms of some of these things, and obviously with a different regulatory framework in the United States than we see in the UK. I think our goal would be really, from an ARC perspective, right? We like to make best practices that are widely accepted. We like to, put things out that are going to help smooth this transition as best possible. So I suspect that from where we are, we're going to do the work. We're going to, we'll probably make sure that we've consulted on, use cases and why people can't use SOFR in its current form, what activities that means, and that would probably inform the degree of our ability to endorse it based on this market dependency of people need to start using SOFR as a first choice in the derivatives markets.
And would you care to comment on timelines? When do we expect to see the first term SOFR being printed in the market?
I suspect that our timeline is probably fairly, fairly near to medium term in terms of the administrator and things like that. In terms of actually endorsing it and having something published, I think it's going to be very, very reliant on what the market does and how quickly the market can move from LIBOR to SOFR for new activity. And with this no new LIBOR, prospect of no new LIBOR sitting out there at the end of 2021, you should think by the second half of this year, we should see a lot of activity migrating, particularly, right, if and when we see the fixing from IBA in terms of the spread. We'll see, ideally, I think we'd see a price convergence at the forward point at that spread. And all of a sudden, it becomes a little easier because you remove a lot of the uncertainty and, really LIBOR just becomes SOFR plus the spread at the forward point. And at that point, it would seem that it would be easier to just reduce your risk by using SOFR.
So do you think that will hopefully neutralize those concerns coming from the lending industry, especially lease finance as well? I mean, we have a number of clients, and we know the industry have typically used forward-looking rates, very short-term, short-dated, plain vanilla products as well. Do you think that will be the final piece in the puzzle, Tom?
Yeah, I think it can be. And I think when we look across this, when this work all began back in 2012, 13, 14, and when the ARC was convened back in 2014, the first version, it really felt that it was a replacement was going to be, we take out LIBOR and we insert something else and we all move on. And we think about how to transition that. But it's turned out that it's not going to be one size fits all. This is going to be very product specific, but the goal would be to cover a vast amount of territory in the market with SOFR in advance, arrears, or the averages. And I think that we still keep pointing people to the average. And we're finding more and more in our conversations that there are people who are interested in using those averages for a lot of different things we might have originally anticipated as well, just as a measure of how to actually reconcile your dailies by looking at the average over the back period. So there's a lot of things that people can do with what's there. But yeah, at the end of it, I think we're going to really become product by product. Derivatives, floating rate notes, institutional products. where does the borrower need certainty of payment well in advance of payment? Those are the kinds of things that are going to inform us, and hopefully we've created enough product in terms of how to use SOFR, enough information that people can select all that. But in the end, I think we know that it's not going to be one size fits all, but it needs to be one size fits most.
Perfect. Thank you so much, Tom. So another contentious issue as well. We hear about alternative RFRs, or sometimes the market calls them ARRs as well. And Ameribor, which is administered by the AFX as well. They came out with an announcement in December that Citi, who is obviously a member of the ARC as well, they're going to help in developing Ameribor products as well. Would you say this puts the ARC in conflict, and certain members in conflict, given that recommendation is SOFR for the US? How are you dealing with that challenge, Tom?
I think the ARC is a big tent, and we've really tried to create an open architecture that we know that firms have commercial demands. We know that we're trying to reach consensus on best practices. We also know that there are large organizations that have to look at different solutions for their clients. So by no means are we I don't think anything really sits in conflict, and I'm not going to comment on any of our competitors or members of the ARC, but I would say that generally speaking, it's going to be clear that there are going to be little bits of the market that are going to have to think about different solutions to different product sets. So as far as we're concerned, the ARC has selected SOFR as the best alternative to Libor after a long consultation over several years to get there. So we think it's the best choice. In the end, the markets are going to make a lot of these determinations. But from our perspective, looking at a rate that's got $1 trillion daily in underlying actual transactions that support it on an average and an actual basis, seems to be a pretty easy choice. And we really, we would just continue to point people to SOFR as the best choice. But it doesn't mean that that people in the market can't try to do the things they need to do to satisfy their clients as best possible.
So would it be a fair assumption to say that we're actually the US is moving to more of a multi-rate, as I liken to say it, home of land of the free, home of the brave, multi-rate curve environment compared to the UK, where we've the BOE have been quite focused on there's just one rate out there?
One of the things that we've always thought about is that that the end of Libor doesn't mean the end of thoughtful creativity around how to price loan products and how to price products. So we would anticipate that as we all move through time, there could be benchmarks that develop over time, as long as they meet the standards, right? As an organization, whether we look at IOSCO compliance, whether we look at what regulators think, there is a determination that has to be made by responsible risk managers that I can use this benchmark. I can utilize this benchmark for these products and feel confident that my clients are going to see fair outcomes using those benchmarks. So there's a stability of benchmark, there's a certainty of these things, that at the end of it, we think SOFR provides the best alternative based on its construction, and as people begin to look at it, we would just encourage and always encourage market participants to look at what the use case is, what benchmarks they're using, are they fit for purpose? And ultimately, if something is fit for purpose, it means it is durable over the long term, good markets and bad markets, and can be reliably utilized over long periods of time. As people look at those rates, if you apply the same standards to that, people may end up at slightly different conclusions for slightly different products and slightly different clients. So I think we may end up in I can't predict the future, but I do think that people will figure out the best way to price their activity using benchmarks that are appropriate for their activity and their clients, while being smart about making sure they're fit for purpose.
Excellent. So great to know the U.S. capital markets is following land of the free, home of the brave. And sorry, as a Brit, I do have to say that. Yeah. But aside from the jokes, aside from the humor, right? Politics, right? Politics and law. The U.S. land of the lawsuit, right? Home of very complex politics, given the way the political system is run. We know Biden is going to be coming into power, hopefully, if Donald Trump exits the White House on the 20th of January. But I don't think that's for us to comment on in this podcast. There's going to be democratic agenda. There's going to be a tie vote, obviously, coming through the Senate, obviously, given the results that came from Georgia as well. What does this mean for, from a Libor perspective? Because we know there are a couple of hearings going on in certain jurisdictions around Libor, and can it still continue? Is it still legal? What about alternatives? How do you think the political agenda, the US political agenda, is going to shape the Libor transition over the next several years now, given, going back to the first point when we opened Libor, US dollar Libor will still be there until the mid 2023. Your thoughts there, Tom?
Well, if you go back, the ARC's been at this since 2014, so we've really kind of, gone through, a variety of regulatory, leadership positions. But I think where we stand is that we're very fortunate on the ARC that we have ex officio members representing all U.S. regulators, and the people who come to the ARC look at this as as part of the work that we're doing. So we don't see any change in approach here. We like the way we structure the ARC because when we meet, we have literally every U.S. regulatory body is represented on an ex officio basis, and supports this transition and has supported this transition since the beginning. So, this is something that we see as steady progress, particularly I think with the notifications that we saw in at the end of 2020, which really kind of again laid out this really clear path forward. And I'd say from the regulatory perspective, the supervisory guidance that we got from the OCC, the Fed, and the FDIC couldn't be more clear. Right? It could not be more clear that people in the market should not be creating new LIBOR contracts after the end of 2021, if not sooner. And so that to me is the foundational regulatory piece. And I think in terms of legislation, the ability for legislation to solve things that don't have fallbacks or have fallbacks that go to LIBOR for investors who oftentimes are pensioners, insurance companies, is something we hope is certainly is valuable across all the entire spectrum of views on this. Fixing this problem is important, is very important to the markets and very important to investors, big and small. So from our perspective, steady as she goes, and we'll get our work done.
So just to end, so hopefully Biden comes and steadies the ship and steadies America's reckoning in the world. Fingers crossed. But legacy contracts, right? There's a lot of talk about legacy contracts, and especially here in the UK, where we're talking about, okay, there's going to be a synthetic GBP LIBOR, and that synthetic GBP LIBOR might be looked at as like term SONIA plus a spread. Do you see a potential synthetic US dollar LIBOR around the corner as well to solve the challenges that the Brits are going through? Will that be a similar issue for the US? And also, Tom, we know Ameribor, and we talked about that a little bit, but the huge big question, and it's not going to come to a surprise to yourself. We're getting rid of a rate which was our funding rate on a balance sheet, historically used for 40 years, right? There's a lot of people who are quite upset, and they're saying, what's my credit sensitivity? I want to measure credit sensitivity, right? Who should be the determinant of credit sensitivity, right? So we know ICE is out there with BYI, Bloomberg, BSBL, that's being proposed as well. There's even an academic proposing a rate as well. We know that there is also a separate group, I think, separate from the ARC as well, discussing all of this. So your thoughts there, given what's happening in the UK, and then these synthetic rates that might come through in credit-sensitive rates as well. Tom?
I think the UK version and the US version aren't that far apart, really. We're all trying to solve the tough legacy, right? So I think, whether it be the legislative path in the US or or synthetic LIBOR in the UK, we're all trying to attack the same problem. And the problem is legacy contracts that have little or no likelihood of being able to be amended in advance of the end of LIBOR. So whether it be a synthetic LIBOR that carries those contracts and allows for greater roll down, or it involves in the US where we have this roll down corridor from the end of this year to the middle of 2023, and we have legislation for the longer dated activity, they're really trying to square up to the same problem, which is there are investors out there who are holding assets that have uncertainty, the potential for dispute and litigation, and by either allowing them to roll down through a longer runway or giving legislation that provides certainty and clarity in fallbacks and reduces the exposure to legislation, to disputes and to litigation, we've really solved the same problem. And I think that whether that be how the legal structures are working in different jurisdictions, all the jurisdictions I think around the world, with the idea that we are now going to, we think, sort of break through on the end of LIBOR, are focused on tough legacy, because tough legacy is where we really have impact with investors big and small. So from our perspective, that's the work that we have to do. And again, back to the the legislative path is important for us. Synthetic LIBOR path is important to the UK. Solves the same problem in a different way. On terms of credit sensitivity, single rate, listen, work has been happening. The regulators have spoken that they're not going to endorse any specific rate. But when we come back to it, banks lend, and banks know how to lend, and I think people will begin to figure out over time at an organizational level what they think the right spreads are for particular types of activities. So, I think we're to the extent that there's not going to be an easy answer, and we've been at this, I say, since think about since 2014. If we haven't found an answer yet, it's probably been pretty elusive considering the number of people that have focused on it. No one's come up with that simple answer. We looked again to see where markets land, see what individual organizations do, how banks begin to keep on lending after LIBOR, and and if things develop over time, I think that's those are important developments. But in the meantime, all of us, I think, have to really contemplate how do we continue the activities we do today when we can't use LIBOR at the end of this year or sooner.
So to finish with, Tom, I think in summary, it sounds like that, yes, SOFR is the path forward from the ARC's perspective. There is a multi-curve environment that we're possibly, we're moving to in the US. There are other term rates, synthetic rates, and potential credit sensitive rates coming. Industry needs to be prepared for that from obviously an implementation perspective across business and technology as well. Would you say that's a fair summary, Tom, and the messaging that you would be sending out?
Yeah, I think the way we would look at this is that, from the perspective of all of this, we are now facing a year which will move very quickly, and where we have to be prepared to continue the activity, right? Because that's going to be the motivating factor. If you think about even today, issuing floating rate notes in SOFR, most likely are becoming, liquidity is shifting from LIBOR to SOFR in particular products. So the markets will go where liquidity is. The markets will go where tighter bid offers are. Things will begin to shift as LIBOR, as access to LIBOR goes down, access to SOFR will go up. And at the end, market participants will figure out how to carry on the activity they want to carry on in safe and sound ways, knowing that their regulators are saying no more LIBOR. So we're really entering a really unique part of this transition where the focus will be on the commercial pressures to continue with the products we have in a world where we can't issue new LIBOR. So, I think the developments are going to be, sort of moving pretty quickly. At the end of it, markets, markets will figure this out, and we look forward to, for people in the industry to look at our best practices, which we think provide the best path forward to the smoothest transition, and be prepared for changes in liquidity, changes in markets, shifts. Keep an eye out for the big bang from the ISDA protocol. Keep an eye on the fixing whenever the cessation declaration happens. These are key. There's still some key pieces of the puzzle we're waiting for 2021, And once they're here, I think that we've got a clear path to transition.
Perfect. So the future looks bright and the future looks positive, Tom.
Always from the ARC, yes.
Excellent to know. So I'd just like to thank Tom so much for his time today and taking time out of his busy schedule as well. Also like to give my support to the Morgan Stanley team and the ARC team who supported with this recording, as well as the risk.net team as well. I encourage all of you to go out there and have a look at the material on the ARC website, have a look at a number of interesting different viewpoints that are coming from the market through risk.net as well, where this podcast will be published. And finally, number of thought leadership articles written by myself and my team at TCS at tcs.com. And also feel free to follow myself and Tom on LinkedIn for the latest updates. I'd like to say thank you to everybody. Thank you for your time and a Happy New Year.